TCJA sunset. Are you ready for the 2026 tax shift? The Tax Cuts and Jobs Act, TCJA, is set to expire in 2025, and its sunset will significantly alter the tax landscape for millions of Americans. This comprehensive guide breaks down the 10 groups most affected and what you can do to prepare. The Tax Cuts and Jobs Act, enacted in 2017, brought about sweeping changes to the U.S. tax code. It provided tax relief to individuals, families, and businesses alike. However, many of its key provisions, especially those impacting individual taxpayers, are scheduled to expire or sunset at the end of 2025. Unless Congress takes action to extend or modify these provisions, the tax rules will revert to pre-TCJA regulations starting in 2026. This reversion will affect nearly every taxpayer to some degree. Certain groups defined by income, occupation, family status, or location will feel the impact more acutely. This informative guide will provide a detailed breakdown of the 10 most affected groups when the TCJA lapses in 2026. The analysis is based on current economic data and tax policy analysis as of March 19, 2025, to give you the most up-to-date information. Our purpose is to inform and empower you to make informed financial decisions. Middle-income families earning between $50,000 and $150,000 annually, particularly those with dependent children, will face a significant financial challenge. The TCJA doubled the Child Tax Credit, CTC, from $1,000 to $2,000 per child and raised income phase-out thresholds. Post-2025, the CTC will drop back to $1,000 with lower phase-out thresholds. Coupled with the loss of personal exemptions, eliminated by TCJA but set to return at around $5,275 per person, a family of 4 could see their tax bill rise substantially. For example, a family earning $100,000 might lose over $5,000 in tax benefits. This will squeeze budgets already strained by inflation. It's crucial for these families to reassess their financial planning. Individuals earning over $400,000 in states like California, New York, and New Jersey benefited from TCJA's lower tax rates. However, they were constrained by the $10,000 cap on state and local tax SALT deductions. If the cap expires, they'll regain full SALT deductibility. This relief will be overshadowed by higher federal tax rates, e.g., the top rate jumping from 37% to 39.6%, and narrower brackets. The Tax Policy Center estimates the top 1% could still see an average tax increase of $20,000 to $30,000. This is despite SALT relief due to their disproportionate reliance on TCJA's rate cuts. High-income earners should consult with tax professionals to mitigate these effects. Owners of pass-through businesses, such as sole proprietorships, partnerships, and S-corporations, enjoyed the TCJA's 20% Qualified Business Income, QBI, deduction. Its expiration will hit those earning $100,000 to $500,000 hardest. They'll face higher individual rates, e.g., 24% rising to 28%, without the deduction to offset income. A 2025 study suggests this group saw a 3-4% income boost from QBI. Its loss could reduce reinvestment capacity, particularly for small retailers and service providers. Small business owners should explore alternative tax strategies to maintain their financial health. Retirees living off pensions, Social Security, and investment income, e.g., $50,000 to $100,000 annually, will lose the TCJA's wider tax brackets. They will also lose the higher standard deduction, slashing from $15,000 to roughly $8,000 for singles. Without personal exemptions to offset the smaller deduction, their taxable income could rise significantly. For instance, a retiree with $70,000 in income might see taxes increase by $500 to $2,000. This will cut into fixed budgets. Retirees should review their retirement plans and consider tax-efficient investment strategies. The TCJA capped mortgage interest deductions at $750,000 of principal, down from $1 million pre-2017, and eliminated home equity loan interest deductions. Post-sunset, interest on up to $1 million in mortgage debt and $100,000 in home equity loans will become deductible again. However, this benefit will be muted for middle and upper middle income homeowners, $100,000 to $250,000, by higher tax rates. The return of itemization complexity may increase their net tax liability by $1,000 to $3,000 annually. Homeowners should evaluate their mortgage and consider refinancing options. Married couples filing jointly with combined incomes of $150,000 to $300,000 benefited from TCJA's wider brackets, which reduced marriage penalties. After 2025, brackets will narrow and rates will rise, e.g., 32% to 33%. This will push more income into higher tiers. A couple earning $200,000 might see their tax bill jump by $4,000 to $5,000. This will erase much of the TCJA's relief and strain household finances. Dual-income couples should reassess their financial planning and savings strategies. The TCJA doubled the estate and gift tax exemption to $13.99 million per person in 2025, adjusted for inflation. Its lapse will slash it to around $7.25 million. This will hit affluent families planning intergenerational wealth transfers. For estates valued between $7 million and $14 million, this could mean $2 million, $3 million in additional taxes at a 40% rate. This will prompt urgent gifting before 2026. Wealthy families should consult with estate planning attorneys to optimize their wealth transfer strategies. Freelancers, contractors, and consultants earning $40,000 to $100,000 relied on the QBI deduction and lower rates to offset self-employment taxes. Without these, their effective tax rate could rise by 5 to 7 percentage points. For a gig worker earning $75,000, this translates to an extra $2,000 to $3,000 in taxes. This will reduce take-home pay in an already precarious job market. Gig workers should explore all available deductions and credits to minimize their tax burden. Households earning $150,000 to $400,000 who itemize deductions, e.g., for charitable giving or medical expenses, will face a mixed bag. The TCJA's higher standard deduction, $30,000 for joint filers, simplified taxes. Its halving to $1,600 plus higher rates will push many back to itemizing. However, the alternative minimum tax, AMT, weakened by TCJA, will ensnare more of them. Exemptions dropping from $140,300 to $110,075 for couples, potentially adding $2,000 to $5,000 to their tax burden. Upper middle-class itemizers should carefully track their deductions and consult with a tax advisor. Entry-level professionals earning $50,000 to $80,000 in high-cost cities like San Francisco or Boston will lose the TCJA's generous standard deduction and lower rates, e.g., 12% to 15%. Without kids or homes to claim credits or deductions, their tax increase, around $1,000 to $2,000, will hit harder. This will impact rising rents and student debt, stunting early career savings. Young professionals should focus on budgeting and maximizing their savings potential. The TCJA's sunset won't just raise taxes, it'll complicate filing as personal exemptions return and itemization spikes. The Congressional Budget Office projects a $4.6 trillion revenue boost over 10 years if it expires. However, this comes at the cost of economic drag. Tax foundation models suggest a 1.1% GDP drop if not extended. Politically, pressure is mounting. Republicans push for permanence, while Democrats favor targeted relief for those under $400,000. As of March 19, 2025, no consensus exists, leaving these 10 classes bracing for impact. For now, proactive planning, accelerating income, gifting, or deductions before 2026 offers the best shield. But for millions, the TCJA's lapse will mean tighter wallets and tougher choices in an already uncertain economy. It's essential to stay informed and take proactive steps to mitigate the potential impact on your finances. Don't wait until 2026 to address these potential tax changes. Now is the time to take control of your financial future. If you like the video, please subscribe our channel and click the bell icon.